Hello, everyone, fellow stock market jobbers. My name is Mark, and I am the stock market jobber. The term jobber is what they used to call stock traders on the British Stock Exchange back in the 1700s. And believe it or not, it actually became a derogatory term when the country was founded, the United States, because the certain people in the government didn't understand that the stock market and financial markets were the future of the country, so it became a derogatory term. So because here at Stock Market Jobber we talk a lot about history and about markets, I thought it was a pretty cool thing to name us after. So my name is Mark, and I am a former institutional trader, and I literally, actually, 100%, I would swear on my grandmother's grave that I was literally a hedge fund trader. People are so obsessed with hedge funds. They're really not as mysterious as everyone thinks. And if you go to our website and you check out under lessons, market lessons, you can see my lesson on what hedge funds really are, what dark pools really are, what algorithms really are. Probably not as mysterious as you think they are. So I began my career working for Mario Gabelli, who's one of the greatest money managers in history. And then I was fortunate enough to make a move over to SAC Capital, where I traded directly for Steve Cohen, who's one of the greatest traders in history. And I was the head of trading at three different money managers, all managed in excess of well over billions of dollars. So I've overseen hedge fund strategies. I mean, I was the head trader, so I had to oversee what everyone else was doing. So I'm a good person to, the marketing people keep telling me I got to keep, promoting myself. And I kind of don't like to do that, but whatever. Whatever. It is what it is. So please make sure you sign up for stockmarketjobber.com or you subscribe. All right, let me get into this here. Let's talk about the SPDR, the SPY. The SPDR is the ETF that tracks the S&P 500. And you can tell it's called, it's not, you don't need to be a market guru to understand why it's called SPY. Well, that's what the symbol is. So we're seeing what I think is some negative action, and I think we're going to go lower in the short term. I also think we're going to go lower long term, and I'll talk about that. But this is a chart of SPY for 8 months, and just wanted you to notice something here. Certain price levels really have more importance than others. In the institutional world, we don't really worry about crazy things like Fibonacci and Gann theory and Elliott waves. That stuff's all a myth. Serious institutional traders worry about price levels, momentum, trends, investment psychology. And that's what we teach at stockmarketjobber.com. It doesn't need to be that complicated. Wall Street tries to overcomplicate things because they want to charge higher fees, or the people that are on the news don't understand what's going on. But enough of that. Let me try to give you a little bit of a trading lesson here. So here's the S&P going back 8 months. Notice how support becomes resistance, resistance becomes support, support becomes resistance, resistance becomes support. This happens, believe it or not, due to investment psychology. Whenever we look at a chart, we got to look at it through the prism of what does this tell us about supply and demand, and what does this tell us about market psychology. Now, a lot of people think technical analysis is kind of weird or whatever, but I'm not surprised because the vast majority of technical analysts, in my opinion, don't know what the hell they're doing. And I'm talking about even some people you see like on the CNBC or whatever financial media you look at, don't know what they're doing, frankly. All right. Because they try to this is this pattern, this is that pattern, but they don't really understand what the pattern shows. But here we have support, it becomes resistance. Well, buyer's remorse. Investors buy here, the price goes lower. A lot of them tell themselves, I'm going to get out, but I'm only going to do so if I break even. So they place their sell orders at the same level they bought at. Here we have resistance becoming support. Seller's remorse causes this. People sell, the price goes higher. A lot of these people say, I made a mistake, I shouldn't have sold. I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price I sold them at. So buyer's remorse can turn support into resistance. Seller's remorse can turn resistance into support. And we see our resistance became support. Another thing is that levels that are resistance or support can remain intact for a while. Back in September, the S&P SPY ran into resistance around 410. Same thing happened here in November and December. And the same thing is kind of going on now. It's generally not a precise level like it is here. That's pretty rare to see. It's more of a zone, but we're talking about a $410 security, and the top of the range is like 415, and the bottom of the range is like 395. So, I mean, sorry, like 398. So basically, we're hitting resistance, and the action today makes me think that we're going to continue to go lower. All right, so let's go look at our next slide here. So we can see we're in a downtrend, and what this means is that, well, we're going down. I mean, it's not, you don't need to be a market guru to figure that one out. But notice how, like, this is the close. The blue candles are ones where the close is higher than the open, and the red candles are ones where the close is higher than the open. So it opened here, it closed there. It opened here, it closed there. Open here, it closed there. Notice how we're having this little bit of lower tops or lower highs. It's a downtrend. And today's action was pretty negative. We looked like we were going forward, but we turn it around and actually closed on the lows of the day. So let me go to our chart of just what today was. Now this is SPY just today. So we climbed up here. We got above that 410, 411 level I was just talking about. Um, we found support there. But then come about 315, 330, we went into a serious reversal. And when markets reverse like this, there tends to be some follow through. So I would not be surprised to see us go lower tomorrow or over the next few days. Now, now this is a longer term chart of the S&P, right? You can see it's 3 years. And a lot of people always ask me, like, oh, Mark, you're a stock market guy. Like, what do you think is going to happen in the market? And I don't blame them. But I've been around long enough to know that no one really knows where the market's going. People have educated guesses, but the greatest money managers in history, the greatest traders in history, are often wrong. I mean, they're right too, and that's why they're doing so well, but they're wrong a lot. So I'm going to tell you why I think in the long run, and I'm talking, next 6 months, next year, maybe 2 years, there's a good chance that SPY gets down to around 320. Now, the first thing is that since World War II, there's been 25 bear markets. Bear markets are when something goes down by 20% or more. All right. The average bear market is down 35%. Well, if we went down 35% from our peak, we'd be right around 320. Okay. The historical valuation of the S&P is to pretty much be around a ratio that would get us down to around there. Right now, we're at the price earnings ratio of the S&P 500 is about 19. In bear markets, historically, it's been around 15. If we get down to 15, guess what? That would put us right down there. So history, valuation, another valuation measurement or metric is price to sales. The price to sales ratio right now is 2.3. That's where it was like, well, it's off this chart here, but if you go back to the internet bubble, that's right where it was, and it was even lower than that right here. Okay, so from a historical point of view, the market is very overvalued and it could still go lower. The last thing is sometimes these price levels can retain their importance for a long time. And markets tend to turn when they get to important support or resistance. As we've seen, resistance become support, support can become resistance. But this 323 level was very important. This is the last time or the last important level before the COVID crash came. We got resistance there and it converted into support. So there you have it, folks. I mean, I don't really think you should get focused on where the long-term market is going. and I don't, but so many people have been asking me about it, I just thought I should put something out. Bottom line is this: I'm wrong a lot of the times. You're wrong a lot of the times. The pundits are wrong a lot of the times. But you know what? The market is never wrong. That's why we let the market tell us what to do. And that's one of the things we focus on stock market at stockmarketjobber.com. The best traders don't come in to work with a preconceived notion of this is what's going to happen. That's what's going to happen. The best traders come into work every day saying, what's the market going to tell me to do today? And they react accordingly. All right, everyone. So thank you so much for checking us out. Once again, my name is Mark. I'm the Stock Market Jobber. Please subscribe to our YouTube page, and please check out our website, stockmarketjobber.com. And hopefully this was helpful, and hopefully I will see you soon. Thanks, everyone.